Costco just announced earnings the other day and revenue. They beat on both. They did $72.09 billion in revenue versus estimates of $72.04 billion, and they reported $4.20 in earnings per share versus $4.17 per share that was expected. The best news, though, is they are not raising the price of their hot dogs yet again. It's going to stay at $1.50, so if you need a good hot dog, go to Costco. I've actually never had the hot dog at Costco. Lisa, have you had the hot dog? Lisa, my fiance, is saying it's a good hot dog. You have too, Maz? Yes. I don't know they have. I'm here in London right now. We're on a trip, and it's a gloomy day. I think that's pretty much par for London, but I didn't know they had Costco's here. I'm going to have to check one out. So let's go use our 8-pillar process to evaluate Costco and see where it is right now. So let's pull up Costco here on our software, COST. Now, this is a company that is loved by Charlie Munger. He's actually said, I will never sell my Costco stock, which I think is a ridiculous statement, but he's a brilliant man and a Michigan man, I might add. So Costco is currently at $4.65, down 4% the other day, even though they beat earnings. So that's kind of surprising. $200 billion market cap. So first pillar number one, we want the 5-year PE ratio of the company under 22.5. So on our main page, right here, 5-year PE, it's 50. Guys, this is a stock that's 50, and guess what? It's at 460. Its 52-week high, 612. So when it was at 612, this 5-year PE was 60, 70, whatever the number is, you can do the math. That's a huge number, especially for a company like Costco. I mean, Costco is generating 2 or 3, 4% of the bottom line on their numbers, and the only way to grow is opening more stores. So pillar number 2, we want the 5-year return on invested capital for the company greater than 9%. So we scroll a little bit here to the right, 5-year return on invested capital, 13.7%. So that's a check mark there. They are generating a high return on the money that's invested in the business. And Charlie Munger believes that if you pay, even if you overpay a little bit for a company, but have a high return on invested capital, you'll probably get that return. Now, does that mean paying 50 times earnings? I don't think he means that, but he very well could. Pillar number 3, very simple, guys. I want revenue growth. I don't care if it's $1. I want revenue growth over the last 5 years. So we go back 5 years ago, 139 billion. Last year, 217. Now, if you decide to go do research on Costco, one thing that's super important for you to do on retail, go find out their organic same-store sales growth over the last 5 years versus sales growth that happened because they opened more stores. Think about it this way. If a company is shrinking per store, if every store is losing 1 or 2% a year in revenue per year, but they open 5% more stores per year, they're going to show a lot more revenue growth, even though the company's demand for each store is decreasing. So you want to make sure that when it comes to any retail business, you look at organic growth, same store sales, versus growth because of opening more locations. Make sure you do that. Pillar number 4, we want net income growth over the last 5 years. So we had $3 billion versus 5.65, check mark there. Pillar number 5. Now guys, this is an important one. This is a silent killer for investing. We want shares outstanding staying the same or decreasing. And the reason being is, if they're increasing the number of shares, that means they are issuing shares. That means you as an investor are being diluted. So for example, if a company has 10 shares outstanding and you own one of them, you own 10% of the business. But if they issue 2 more shares to raise capital, they now have 12 shares to split all revenue, profit, and everything amongst. Now you own 1 out of 12 shares. You own 8.3% of the business. You went from 10% to 8.3%. Just remember that going forward. Companies will do that because nobody watches this number. So at the end of 6 years, they had 438.8 million shares. They now have 443. That's an X. They have actually increased their shares outstanding by a little over 1% over 5 years. Not the worst thing in the world. I can let that slide. That is not a big, I'm looking for companies that are increasing their shares 50, 60, 70%. That's my main, or even 4 or 5% a year. Whatever it is, I want to make sure they're not doing that. All right, now pillar number 6 has to do with long-term debt. And debt works the same for a company as it does for you as an individual. Companies that have a lot of debt, when times are tough, will have a harder time and more likely to enter into financial problems and even bankruptcy. So we want to find companies that have reasonable debt levels. So what's a reasonable debt level? Well, my metric is very simple. I go to the 5-year average free cash flow on our main page. And in this case, it's 4.2 billion. I multiply that by 5. So that's a very simple number, 21 billion. So I want the long-term liabilities of the company to be under $21 billion. So I go to the balance sheet, I scroll down all the way to the bottom. Long-term liabilities, $11.5 billion. So we have a check mark there. They have almost half the debt that I feel comfortable with. That means that they can pay off their debt in their long-term liabilities in under 3 years of their average free cash flow. And the other thing I want to show you is pillar number 7, which has to do with free cash flow. So what is free cash flow? Very simple. It's cash from operations less your capital expenditures. I do not look at EBITDA. EBITDA takes out depreciation, but free cash flow is after your capital expenditures. Depreciation is a real cost. That's what the capital expenditures are in a company. So you need to look at the free cash flow as the real lifeblood of the business. This is a true way of looking at what's the cash generated from the business. Because remember, earnings are great. And over a long period of time, earnings and free cash flow should be very similar. But earnings get manipulated from SEC rules, accounting rules, all these tactics that companies want to do. They can manipulate those earnings. Cash flow can still be manipulated, but it's a much harder task to do. So we're on our free cash flow statement right here. We scroll a little bit. Now, your favorite Uncle Paul has added the free cash flow line here to make life easy for you because I know math is hard, and I'll show you another shortcut for all this math later. 5 years ago, $3.36 billion in free cash flow. Last year, 4.1. Check mark there. So they have growing free cash flow. Their final metric is we want to come up, just like the PE, we want to come up with some sort of value for the business, okay? Now, we look at the way I do that here is I take the exact same thing. I take the 5-year average free cash flow and I multiply it by 22.5. So here was 4.2 billion times 22.5 is $90 billion, okay? So we want the market cap of the business to be under $90 billion. So we go here to the metrics page, scroll here, $206 billion. So that's an X. That's pretty obvious considering their 5-year PE was 50. So we knew that it was going to be a bad number. Now, if you're new to this channel, I'm Paul. I've been teaching in value investing for about 10 years now, the last 3 years on YouTube. Just because I have a YouTube channel and just because everybody else has a YouTube channel does not make them an expert in what they're saying. But I guarantee if you watch 4 or 5 of our videos, you'll walk away being smarter about money and investing, and you'll realize that this process is a sound financial process, and it'll help you, even if you don't agree with me, you'll understand investing a little bit better. So now let's look at the analyst estimates for Costco. So our data feed here on our website pulls in analyst estimates. For Costco, it's about 35 analysts. And remember, these aren't all the analysts in the world following Costco. There's probably 1,000, but maybe not 1,000, but several hundred. But this is our data feed. So look at EPS. That's actually pretty good growth for Costco. And I think a big reason for that is probably if they decide to buy back shares, they're probably going to drive up their EPS. So they're looking at low double digits for the next 5 years. And in terms of revenue, boom. So again, I want you to see Costco, I'm sure, in their 10K or somewhere in some sort of phone call will explain what their growth opportunities are. How many stores they have, how many they plan on opening, how many they plan on closing, etc. I imagine a lot of this growth is going to come from that. So what do we do with all this? Well, now we go to the stock analyzer tool. This is probably this is actually the most popular part of our website. What we use this for is every investment is the present value of all future cash flow, but we don't know the future. A lot can happen in the next 5-10 years. So we have to make assumptions about the future. And my job as a value investor is to make reasonably conservative assumptions and account for things that I can't think about and hopefully find companies selling at a price below those conservative assumptions. In the last 10 years, it's been harder to do because the market's been booming. But if you go back and look in history, this always happens. Great companies with great financials eventually sell at a good price, below their historical metrics. That's always what happens. So your job is to find these companies now, and even if the price isn't where it is, you can add it to your watch list above, and that way, when it does hit that price, it notifies you via email or on the phone or on your software to actually let you know the stock has hit that price. So I highly encourage you, as we're doing this software, as the stock analyzer, to rewind this part, because I want you to understand the real way in which I use the stock analyzer tool. So first off, I'm going to do a 10-year analysis here. Revenue growth. Again, my goal is to be conservative, and their revenue growth numbers, but based on analysts, were high single digits. I use the analyst estimates as my high side because they tend to be a little more aggressive because they want to make these companies happy that they're there. And if you think that's not true, then grow up. But that is true. So I'm going to go high side. I'm going to go crazy. I'm going to go 10%. Actually, you know what? That's a 5-year estimate was high single digits. So I'm going to go 9%. Middle, I'm going to go 6. Low side, I'm going to go 3. Guys, 3 is very low. I absolutely believe 3 is low. But again, it's kind of like showing the extremes here. One extreme low, one extreme high. Next, profit margin. Look at this adorable profit margin, 2.2 to 2.6%. Guys, I'm going to keep it very steady. 2, 2.25, and let's say they crush it and make 2.5 cents on every dollar they bring in revenue. All right? Free cash flow margin. It's pretty much the same. So I'm going to do exactly the same thing. Guys, this is Costco. You're probably shocked to see this. A friend of mine recently, we were talking about Walmart, and she was complaining about how Walmart makes too much money. And I said, hey, what do you think their profit margin is? And she said 50%. And I went like this. And she goes, 40? I go, no, 4%. Like these companies don't make these grocery stores and these retail locations like this, there's not a lot of margin. You're going to Costco to buy your essentials. I mean, how are you really going to generate big margin on that? That's going to be a very difficult thing. So don't expect you're buying some big cash cow. So PE. Now guys, there's 2 reasons that PE and price to free cash flow should be high. 1, growth potential, and 2, some sort of moat or high return on invested capital. Costco has the moat. Like people love Costco. People buy their pants at Costco. Like people love the clothing at Costco. My fiance will not let me buy clothing at Costco, even though I love their clothes there. I'm just kidding, by the way. But Costco is a high moat business. But again, how are you getting your money from Costco? Retail is becoming harder and harder, but they have a good brand and they have a good niche in the market. So you have to be subjective here. I'm actually going to go 13. Actually, I'm going to go 12. You see me hemming and hawing here. And the reason being is it's still not a sexy business. And as it grows and grows, it's going to be harder to grow. I mean, these are high capital intensive businesses to open. I don't see how you can really, it's one thing if the company was such a tech company where they can reinvest the money at very high rates of return and deploy a little bit of capital and make big returns. It's not. To open a Costco, I imagine, costs millions and millions and millions of dollars. It's something to consider as part of their PE and price to free cash flow multiple. And I'm going to mimic that for their price to free cash flow. So we're at 12, 14, and 16. And finally, annual return. In this situation here, you can invest in a low-cost ETF and get 9 or 10% from the market. So in order to invest in an individual company with ample margin of safety, it's important you put a return that's higher than that 9 or 10%. And it can depend on the uncertainties. I don't think there's a lot of uncertainties in Costco. So I'm going to be a little bit lower. I'm going to go with 12% on the low side. I'm going to go with 13% in the middle. And I'm going to go with 15% on the high side. The reason I went 15% here is these are very high assumptions, I believe. They're assumptions that except for the revenue growth, which is going to slow as time goes on, they haven't hit these numbers over long periods of time. And so I'm going to be very conservative about that. Now I'm going to hit the analyze button. 6 numbers are going to pop up. 3 prices based on a multiple of earnings and 3 prices based on a multiple of free cash flow. If it's all green, it does not mean go out and buy. It means go out there and verify this data. How do you verify the data? Very easy. Go out there and research. Join our community, everythingmoney.com. For like $1 a day, you can go in there. There are thousands of people in there every single day talking about investments. You can have a conversation about Costco, specifically search for it. Go to the conversation, talk to people. What have they found? Because research as a group is so much easier than research individually, and that's why we created all of this. So go to everythingmoney.com and check it out. If it's all red, doesn't mean don't go out and buy it. If you love the company, get your research done, get ready, add it to your watch list, and the software will email you and also send you a message on the app when it hits that price. So I'm hitting the analyze button here. Okay, guys. Not shocking. Look at this. A low price of 114, a high price of 206, mid price of 160. My opinion is just hold off for now. Wait till it gets lower before you start doing research. I appreciate you watching this video. If you want to understand more about margin of safety, go watch this next video. You absolutely have to watch it because margin safety is one of the most important factors in investing. Thank you for your time.